Welcome to Stock Insights, your one-stop spot for stock and crypto analysis and discovery. Today we got a banger for you guys as we're looking at a new feature that's been released on Robinhood called the profit and loss chart. We're going to see how it works. We're going to see if there's any practical application that we can get from it. It does pertain to options. So if you're not familiar with options, I'm going to be briefly going over options, but I strongly advise that you check out other YouTube videos and go more in depth into options, as I won't be going that far into depth into it. Okay. So I have looked over these new features in both the desktop and the mobile version of Robinhood. So I'm going to be showing you both sides so you can see how it works on the mobile version and on the desktop version. Some things I have to say work and some things don't work. Okay, so stick around to the end of the video so you can see what works and what actually doesn't work, so you can have a better understanding so you can use it for yourself. This is going to be the first video of its kind on YouTube regarding this profit and loss chart on Robinhood. I did my searches. I couldn't find any videos. If you're just coming across this video and you're new here, consider subscribing, as I do talk about stock and crypto on a weekly basis. I got YouTube shorts that I go into quick discovery and analysis of certain stocks and cryptos. So let's get right into it. All right, so first and foremost, let's just give a brief definition of what an options contract is. So an option is a contract giving the buyer the right, but not the obligation to buy or to sell. So in the buy scenario, it's a call option, and in the sell, it's a put option. But so it gives you the right, but not the obligation to either buy or sell an underlying asset. So in our example, we're talking about stocks at a specified price, so a specific price, which is called the strike price on and before a certain date, which is the expiration date. Okay, so people use options, this is for income, to speculate, to hedge the risk. Stock options that we're talking about, they typically represent 100 shares at a time. So that's what we're going to be talking about, stock options, and how they talk about 100 shares at a time. So we're going to break this all down. We're going to use the example of NEO. All right, so this is NEO via the mobile app. Okay, so this is the options contract here. Let me just back up. This is NEO. Okay, so that's the stock price. We click on trade, click on trade options. It's going to give you, I think it's going up. Click on April 1st, and this is on buying a call. Okay, so this is thinking that NEO is going up. All right, so the current share price of NEO at the recording is $38.89. So in our example, we say this is between the buyer and the seller. At an agreed upon price. So let's just use the price of $39. So that's the price just above. So in our example, a buyer would and the seller would agree upon selling his NEO contract, which is 100 shares at $39, which is the strike price, okay, at April 1st. All right. So there is a pay-to-play amount. So the pay-to-play amount for that NEO call is 83 cents, it shows here. But we got to remember, an option contract is in terms of 100. So we got to multiply that 83 times 100, which gives us 83. So $83 is what the buyer pays to enter this contract. And what they're hoping for is that before April 1st or by April 1st, which is the expiration date, then NEO goes to $39 or above so they can make money. If NEO does not make it to $39 or stagnates or goes down, this option expires worthless and the buyer loses $83. So now that we see this example, let's get further into it and look at the profit and loss chart that Robinhood is offering out. All right, so this is from the Help Center here. This is new, the P&L chart, profit and loss chart. So what is a profit and loss chart? The P&L chart is a chart that helps you visualize an option strategy, theoretical profit or losses at expiration. This is a great way to gain some insight into any particular option strategy before you enter into a position. All right, so this shows you how it works, and it doesn't really break it down, but these examples just show what these lines mean. Okay, so the vertical y-axis represents the theoretical profit and loss range. Okay, so it gives you a range of where the profit is, which is typically unlimited, but the loss is defined. Okay, so anything above zero represents theoretical profit, while the area below represents theoretical loss. Both values assume the option is held until expiration. Excuse me. The horizontal x-axis represents the stock price at expiration. When it comes to a calendar spread, I'm not going to get into that. Okay, so I only have level 2 access on Robinhood. I don't have level 3. I haven't made enough options trades on Robinhood. So I'm not going to get into the iron condor and certain option strategies. We're going to keep this basic just so you can have a look at how this profit and loss, I'm just gonna call it a graph they built into it, how it looks. Okay, so we're first gonna look at how it looks on the desktop version. We're gonna look at the SPY, which is one of the most liquid options out there, and we're gonna look at this profit and loss chart. All right, ladies and gentlemen, this is the Spider ETF, ticker symbol SPY. One of the tracks that S&P 500, the 500 most biggest companies in the United States. Okay, so what we're going to do here is we're going to click on trade SPY options. It's going to take us to the options chain. All right, so before I get into it, I'm just going to change the expiration date to April 1st. Okay, I'm just going to center this. All right, so we've seen the Neo breakdown, so we're just going to break this. The Neo was the mobile version, so this is the desktop version. Okay, so as the SPY goes, the current share price is $396.20. For this example, we're gonna say that the buyer believes that the SPY is going to $398 by April 1st. Okay, so this options contract right here. Okay, so the strike price is $398. That's the price that the buyer and the seller agree upon. Okay, the premium, the pay to play, is 57 cents. Okay, and then this break even here, $398.57. This just means that even if Spider gets up to $398, the break even, you have to include the premium that you paid to play this option. Okay, so to break even, it is getting up to that strike price that you agreed upon plus the amount that you paid for to play this option. Okay, so let's click on this. Let's act like we're going to buy it. I can't buy it. I don't have that much in my account right now. As you see off to the side here, it takes you directly to this profit and loss chart here. Okay, so in this example, you would spend $57 to get into this options trade. Okay, this here is showing you like at the money, or before anything happens. Okay, I'm sorry, that's this back here, I believe. But if you go back here, this showing that the expected loss, regardless of how far back or how far down the SPY falls. So it's at 396 right now. Let's say that it drops to 350. Okay, and drops to 350 by April 1st. Your max loss that you can experience is $57, which is the amount you paid to play. Okay, the max profit is unlimited. This only shows you up to 402 or whatever, but it's unlimited. The Spider can keep going up and up and up, and you can keep getting profits. Okay, this is very simple. It's not a lot to it. Okay, and this is for buying a call. Okay, so let's just switch it up. I'm going to exit out of this. Now I'm going to buy a put. So this is saying the opposite. This is me saying that I believe that SPY is going down. Okay, So again, it's at 396.49 right now. Let's say that we believe it's going to go down to 395. Okay, so as the buyer, I'm saying that I believe that the SPY is going down. The seller and I are agreeing on me believing that it's going down to 395, which is a strike price. For me to play this option, it costs 82 cents times 100, which is $82. Okay, let's click on it. So you bring up the chart, and you see it's backwards. This is the inverse. So as we go forward, this is the price of the SPY going forward. And if you're buying a put, you want this price to go down. You think it's going to go down. So that's why you don't see anything going up. And it shows the max loss is what you put into it, $82. Okay. If you go backwards, though, as you see, okay, we're starting here. As you go backwards, so this 394.18, this little blip right here, this is the break-even price. And the further you go, the further the SPY goes down, the higher your profits are. Okay, so this is just showing how it is on SPY for the put side. Okay, so what I'm going to show on the mobile version, well, before I do that, I might as well show it here. Let's exit out of this. So let's go to the sell. So let's sell a call. So this would be considered a covered call. Okay, this would be an individual that owns 100 shares of the SPY and they want to make the premium. So remember, we said there's a buyer and a seller. The seller is the one who's collecting the premium. If you want to be the person that's selling these options contracts, you're going to want to sell a call. Okay, so let's go to the 398. I think that was what we did in our first example. Probably not. And let's look at this. Okay, let's look at the profit and loss chart for this. Okay, so this is where I don't like how this looks. Okay, so when you're buying a covered call, okay, on the seller side, you don't want the stock price to go up because you want to keep your shares. Okay, and most likely you want to keep your shares. Okay, this is showing that your max loss is unlimited, which is incorrect, and this could possibly have new traders confused. Your max loss is not unlimited. So let's just say an example that you have to sell your shares. Okay, you're selling your call option to a buyer. It reaches 398. That buyer exercises the options, so now you have to sell those shares. Okay, if the SPY, let's say theoretically, goes up to 500, okay, you still have to sell at 398. So it doesn't matter that it went up to the 500 and you own those shares. You don't own them once that contract is exercised. So whoever exercises that contract, they get to buy each share at 398 and they get to experience that $500 share appreciation. You're not actually losing that though as a seller. Yeah, you sold out, and yeah, you don't experience that share appreciation that the buyer has, but it's not a loss. So this is very deceptive in saying that this is a loss or the max loss is unlimited, because it's not. You lose the 100 shares, but you're not really losing. The person that's buying those shares for you are actually buying those shares. They're not buying it at 500, which you would probably want them to do, but they are buying it at the 398, which was the agreed upon price. So let's look at the put side of things, because the selling the put is the same thing. It's showing you unlimited losses, but that's not true. Okay, so a cash secured put is similar to a covered call in that you have enough capital to purchase 100 shares. Okay, so in a covered call scenario, you have the 100 shares. In a cash secured put scenario, you have enough capital to purchase 100 shares. Okay, and this is sometimes an entry strategy that some people use to get into certain equities. So this is saying, so let's just use this example. So this is 396.50 right now. Let's say as the seller, you believe that it's going to go down to 394. Now sometimes, typically, this is just an income strategy. So the seller doesn't typically want the share price to go down, because that would force them to have to purchase 100 shares. But sometimes they use it as an entry strategy. So as we look at this here, again, this is showing that your max, this is even further off than I thought. I mean, this is saying that your max loss is $39,344, but that's incorrect because you're not losing anything. Now, you are purchasing shares, but that doesn't mean that you're losing money. You're exchanging, well, you're honoring the contract. You're exchanging funds for actual equity, okay? So this is saying that if you were exercised, let's say that, well, let's just use this example. Let's say that the share price dropped to $300, okay? You would still have to purchase each share at $3.94 per share, okay? So in that sense, it would be a loss, but it's not, $39,344. That's incorrect. You're not losing out. You'll be losing out on the difference because you would still have to purchase the price at $3.94 per share, but you wouldn't be actually losing out. You would still own that equity. You would hope that SPY would recover those gains and that you would get those gains back, but you're not actually losing out. You're just buying the actual equity. So that's my gripes with the profit and loss that they have here. So what we're going to do next is we're going to look at the profit and loss on the mobile version. This is going to be real quick. We're going to use let's use Tesla. We're going to look at Tesla and just look at the mobile version of how this works out, okay? All right, so we're here on the mobile version of Robinhood, looking at Tesla. Close today is $663.90. So we're going to go into the options here. Okay, we're going to click on April 1st. So we see $663.90. That's the break-even price. Okay, and we're just going to go over the buy side. We're not going to go through everything like we did on the desktop version because it looks the same. Okay, so let's say that we think that Tesla is going up to 665. Okay, so we're going to click on that. So we see here above the review, see that little caret pointing down. It shows max profit, break even, and max losses. Just click on that, and now we see there is that profit and loss chart. Okay, so in this scenario, the max cost of this contract would be $1,063. Okay, so that's what this shows you. The maximum that you can lose. Well, it's saying $1,065 because of Robinhood adding on $2 extra to conduct this options trade. But that's the maximum you can lose. You can only lose what you put in, and it's just showing unlimited gains again that you can keep going on forever. Now the break even here is $675.65, which, like we said before, that takes into consideration the strike price plus the premium that you have to pay just to get into this options play, so you can play the play. Okay, so yeah, this is just the mobile version of it. It's very similar to the desktop version, probably just a little bit more simpler. Let me just go over the put side. There's no reason why. So we have a buy here, buy, put. All right, it's going to take us down. So let's say that it will go, we believe it's going down to 660. We're going to click on that here. And again, guys, we show if we go backwards, that's where we get our gains. Okay, so put means that we're believing it's going down. So if we take this little line and go backwards, and then you can start seeing the expected profit. If we go forwards, as if we're thinking that the price is going to go up, we see that the maximum loss that we can experience here is $550, which is the cost to get into this contract. Okay, so hopefully this helped you guys see, the profit and loss chart on Robinhood, so you got a better understanding of it. If you believe that it's going to be helping you out in your journey, please leave a comment down below. I would love to hear how you guys are expecting to use this. If you think it's going to be useful, if you don't think it's going to be useful, please let me know. If you guys had any value from this, please subscribe. Like I said before, I talk about stock, I talk about crypto, I give weekly updates. I have YouTube shorts where I do stock analysis, stock discovery. This is your one-stop spot. Thank you guys for checking this out. Have a good one.